Welcome back, everyone, to another episode of the European VC Podcast. Today, I have Christian Meermann, the founding partner of Cherry, with me. He's also a Forbes Midas Lister, in case you're thinking, didn't I know that name? So we are diving into a conversation here where we're talking all about building Cherry, the culture of excellence, as well as competition in venture. But we're also diving into a topic which I think many of you will enjoy, which is, of course, how to underwrite new managers in the current market and what to look for, as well as the decision-making when it comes to follow-on rounds in venture.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.
This show is not investment advice, and the hosts of this episode may be invested in the funds and companies featured.
Christian, welcome to the European VC Podcast.
Andreas, thanks a lot for having me.
I'm super excited about this. From our first intro call, I was like, this is going to be so fun. So I'm happy that it's happening now.
Yeah, likewise.
Christian, let me just run through the core stats on you and Cherry, and then we can talk a bit about the context that goes with that. You're Christian Meermann, and you're, of course, the founding partner of Cherry Ventures. You've got the latest fund is 320 million euros, and the total AUM is around 1 billion. You're headquartered in Germany. You're doing early stage, pre-seed, seed plus, and you're focused on all of Europe. Target sector and vertical is very broad. You can do, as I remember, pretty much everything, but you are focused on SaaS primarily. Am I correct in saying that?
Yeah, that's good.
Good.
I mean, I would say we have done a lot of consumer previously, but in the current market, it's obviously much more B2B software.
Yeah. And we're going to talk a bit about that. And of course, notable investments, Flixbus, Auto1, Flaschenpost, Finimize, and Ninetailed. Flixbus, I remember when I saw that Flixbus had acquired Greyhound, and I was like, that must have been such a truly mind-numbing moment, because Greyhound is this bus that you've seen all through your life in the big US movies, and then a European company, Flixbus, this weird colored bus that comes driving through Denmark all the time. I was like, and they acquired Greyhound? That's incredible.
Absolutely, yeah.
Tell me a bit about the founding story of Cherry. I'd love to hear, how did Cherry come about?
Yeah, no, happy to tell you that. So Philip, my co-founder, and I, we were both entrepreneurs before. So we were both building up Zalando. Philip was heading product. I was the CMO, so doing everything that had to do with marketing and driving up revenues. And back in the day, at some point, we could do a small secondary, and then we had a bit of cash. And the question was, what are we going to do with it? And we said, why don't we start angel investing? And also, this is now more than 10 years ago. I think the German tech scene was kind of way less developed than it is today, obviously. And then we said, hey, let's do this as a hobby on the side. And then early on invested into Auto1, Flixbus, Quandu, Amorelie, which was big in Germany back in the day. And always enjoyed it since then. And then after the Zalando IPO, we both asked ourselves what to do next. And then it was, I'd say, a pretty natural move to say, why actually don't we do what we love to do as a hobby and do this now full-time? And that's how we came to Cherry full-time, raised external money, and then started investing as a proper job.
As a proper job, yes. And it's been a good job. You've done well. Congrats on that. I'd love to ask you, how do you think that this journey with Zalando has shaped you as an investor today?
Yeah, I would say it has shaped me personally massively. And I think also our whole team. So I think how we are different as a firm is that we all as partners have entrepreneurial backgrounds. So if you look at Sophia, our partner in the Nordics, she was very early on in Spotify. So she brings that kind of DNA. Then Dinika, our partner in London, she was building up Uber here in Europe. So we all have this entrepreneurial DNA, and that's what all unites us. And it comes from different companies, so it has slightly different ways of looking at it, but that's also what makes us strong and complementary. But I think having been on the other side before just makes a ton of difference. And then talking to founders and helping them on their journey towards building, hopefully, kind of a very good outcome, that makes a difference versus just having been in a bank before as an investment banker and then kind of switching to startups versus, having done this real life before and knowing all the ups and downs in that journey.
Whenever you talk about operators or founders turned investors, you always talk about, yes, it's definitely a strength, but it can definitely also be a hindrance, or you have this propensity for action, which might not be the propensity you want to have as an investor, because sometimes what you want from an investor is just that they know how to shut up. How do you navigate this? How have you seen it play out in the firm? You're obviously you're more than 10 years in, so obviously this is some time back where you wrestled with those thoughts, but I'd love to hear.
Yeah. Look, I'd say kind of that has changed quite a bit, but in the very early days, like from switching from entrepreneur to investor, it was hard. I think for me, it was especially, kind of having done marketing before, and kind of at Zalando, I was responsible for top line, right? And for marketing spend. And the good thing about it is you spend dollars today, you see the impact tomorrow, and you can act super quick. If you feel things are not working out as planned, you optimize more, you see your results immediately. You get immediate feedback. Then switching sides as an investor, you deploy money today, you invest in a startup, you partner with the founders, and then suddenly 3 months later, you feel like, ooh, this kind of, was more challenging than expected, but there's basically nothing you yourself can do, right? You can sit with a founder, try to support and discuss, but you personally are not going to have kind of that immediate impact. And if the company decides to do marketing one way and I would have done it the other way, that's what you have to live with as an investor. And it's fine, right? So the entrepreneur should decide. They are in the business. They know much better what's kind of the right thing for the business. But I think, being one layer more removed as an investor, that in the beginning was a bit tough to accept. But yeah, after like half a year, you get used to it. And I think it's also good to have more distance as an investor, and because it helps you to fly a bit higher and also stay objective on the key decisions.
Where do you think that this operational experience gives the highest value, and where does it maybe end and it's not that important?
Look, I'd say still the highest value is on the strategic side. So when it's about sparring on different topics, sometimes early on the company might have to pivot, is giving our view on this, or whether it's, hey, should we do this M&A now, or should we rather grow organically? I think there we can add a lot with our expertise and know-how. I think where it ends is, on nitty-gritty input. I think it's not our job to fine-tune campaigns or to go through every single cost line of a business and question every decision there. I think that's where it's going too far. But I think on the strategic sparring and challenging, I think that's where the value comes in.
You were operators both at Zalando, right? You were not the founders.
Yeah.
Sometimes people distinguish a bit between operators and founders. I'd love to ask you, one, do you think that's meaningful? One, do you think it's not? And do you get my question? Like, I'm trying to figure out, because the way I would think about it is that there's founder mode and manager mode, but there's also operators that are in founder mode. What's your take on that? Do you sometimes get asked that question as well?
I'd say, look, we both kind of joined super early on, and we were part of the kind of extended founding team. So I think, and Robert and David as the kind of original two founders, I think they did a great job in having everyone in this 5, 6, 7 people team feel like as if it was our own company, right? So I think we always felt like entrepreneurs and as if it was our company. So, every dollar I spent wrongly, I felt pretty bad about, right? So not like a manager where like, doesn't matter, part of my job, I move on, I felt like, hey, shit, I have burned our investors' money, could have done better. So I think that kind of makes the big difference. And that's also what the difference is between like, a manager or someone that you hire at a later point in time in a company that has done it beforehand, but just sees this as one of their gigs kind of in their professional life. And they do this for 3 years until they move on to another company where they maybe earn more or see the challenge more exciting. I think here it was like, hey, kind of we're building this from the ground up, and everyone is essential to that in his or her specific area.
When you started 10 years ago, we didn't have many founder investors or founders turned investors. We have a few more of those today. And definitely ventures gotten more competitive in Europe. How have you seen your competitive edge being a founder-driven firm? Have you seen it wash out, or have you seen it be, just as strong as it was back then? Do you see, how have you this really, the competitive dynamic of European venture changed in the time that you've had, been building Cherry, and where have you seen your position in being made only stronger, and where have you seen, okay, we have to reposition it a little bit?
Overall, the market got more competitive because there's just also way more funds out there now versus 10 years ago. On the other hand, you see also that trend being reversed a little bit right now, right? So there are a bunch of funds kind of going out of business or just not raising another fund. So that is changing a bit. And then on the other hand, also we as a firm have developed further, right? So initially when we started, it was like a Berlin-centric firm. We started with investments in the German-speaking region. But by now, kind of with offices in Stockholm and London as well, and people on the ground there, kind of we are a proper pan-European firm. So we're going to have also kind of increased our footprint massively. So we're seeing kind of all relevant deals in Europe. And that, I would say, has changed quite a bit versus before. And then I would say, yeah, there are a few more entrepreneurial venture firms, but not many more, actually. And therefore, I feel, look, it's always about the individual. It's like, kind of how do you vibe with the founder that you want to partner up with, and does the founder see the value in you as a person and as a firm? And I would say that has only gotten better. So yeah, very positive about the positioning.
VCs are always very quick to say that being a founder of a startup is harder than being a founder of a VC firm, and never liken their own path to the founders and their struggle. Do you think that's true? Or do you think that that's more VCs being mindful of showing humility towards the trail that the founders are walking, but in fact, it is similar journeys, and it is equally hard to build a venture firm as it is building a startup. It's just different, but definitely you bleed as much when you're building a venture firm.
Yeah, I'd say, look, it's a similar entrepreneurial challenge in the sense of kind of you need to raise money, you need to build out a team. There's ups and there's also downs. So I think that is similar. I think what's different is, and I think that's what most people refer to, is I think it's a little less volatile in the sense of, you collect money from LPs. It's a 10-year horizon per fund. So the management fee you get kind of to pay kind of your team, it's fairly constant. So you have guaranteed revenues for 10 years, which none of our founders have, right? So if you have an incredible SaaS product, okay, you might get into similar spheres, but you also never know, right? It's a 1 or 2 year contract that then gets renewed, but no one tells you, hey, where can I sign for 10 years up front, right? So I think that is quite different. So it gives us more stability. I would also say that stability is needed because you are in a long-term game, kind of you need consistency in your team and make sure kind of you can be a good supporter in this journey, and you don't have to worry about your own funds like in the middle of that journey. So from that perspective, I think it makes sense. But yeah, I'd say all the rest is similar to building a startup. And it's funny because when we started Cherry, then some people say, hey, yeah, why don't you want to build kind of your own company? And I was like, wait a second, like Cherry is my own company. It's just a venture firm and not kind of a tech startup. But the journey, I would say, is pretty similar.
Yeah, and I definitely get your point with the volatility, because first of all, also the pace of a startup, the activities and the market movement and the iterations are quicker than in venture. But I think there's also probably another big thing, which is when you're building a venture firm, you're walking a path that others have walked before. So there's probably a more well-written playbook. And you're also moving alongside other giants that you know and trust, and who know and trust you. So I think there's more people that you can lean on, that you trust, and that you can have these conversations with around how are we doing this. And I imagine also, given the number of firms that have spun out of Zalando, from people that have been closely connected to Zalando, I imagine that you have a very strong community of people that you can kick tires with when it's about building Cherry. And
absolutely. And that's also even how we got started, right? So when we said, hey, let's do Cherry full time, we thought about, okay, where are we going to get that money from? And I think going to institutional investors on day one, just with a pitch deck, but with having €0 raised, it's not the easiest thing to do. So, and it was a bit more kind of by chance. We were like chatting to friends, other entrepreneurs, telling them what we were going to do. And then they were all pretty interested. And they're like, oh, hey, that sounds cool. Like in kind of entrepreneurial VC, like where can I invest? And we're like, okay. So they want to write an LP check. And that's actually how we got to the first 30 million. That was just by raising through our network, which is kind of, people well that trust you. And that's after that we just got to institutional equity. So I think, yeah, it is a good environment. It's very overall kind of friendly. I mean, it's obviously competitive when you fight for deals. But other than that, it's a good and friendly environment.
Just a note for all the emerging managers or the people that consider raising funds or on the first fund, listen to that story, right? You had almost 30 million, not in the bank, but you had a lot of interest from people that were wealthy and who had run the journey of a founder or an operator, highly achieved operator, to you be able to actually build your fund on that basis. That is a markedly different route than the people that I talk to that are struggling to raise the first million or two to get off the ground. And I think that sometimes that is a strong signal to you as a aspiring investor. Maybe if my journey doesn't look like the greatest firms in Europe, maybe there's a reason, maybe that's a signal to me about not moving too quick into this. I just say it because I've seen so many, fight, and in this market now, it's not fun at all. What do you say when you meet? I'm sure you meet a ton of emerging managers, angels wanting to turn VC. What do you say to them?
Look, I think first question is always like, what is kind of driving them, right? So like I ask, look, why are you doing this, right? It's a very long-term game, gonna have a small fund, you're on your own, right? So you suddenly gonna need to decide on every single deal. You have to figure out with yourself, is this a good investment or not? Am I caught, like am I somehow in love with the idea, with that founder, but is that actually 100% objective, and am I being super rational here? So I think I always try to understand what's the motivation of those kind of solo GPs. And I would say for the good ones, it all comes down to they are super passionate about it and they love their business. They have usually kind of, learned it somewhere else, like in another venture firm. At some point they said, hey, I want to do it myself, or I want to do kind of more earlier stage stuff. And that's kind of how they start their business. And I think then it's a great motivation, right? So if that's kind of what you love doing and spending time with entrepreneurs and then being super early on and dreaming together with them, I think that is great. But it's, it's a long journey. A 10-year fund lifetime is long, and then comes the next one and the next one. So you're in it for quite some time. So you really have to figure out initially, do you want that?
Have you personally backed any managers?
Yeah, a few actually. Yeah.
What have been the characteristics that define them?
I would say for the best ones, I think they are all like, first of all, they all bring this passion. They really love that. They're all, second, they're all very social, because I think you need to be quite social and quickly figure out like who's building what, where do I meet them, and so on. And I think they're all working extremely hard, right? And traveling a lot and hassling a lot to get into the deals, because it's also there that it's competitive. It's not that, okay, no one else wants to give you money on day zero. There's also a bunch of angels out there, solo GPs, small funds. Also on that level is quite some competition. So starting as solo GP just because you think, oh, it's so early, there's no one else around, it's going to be a great opportunity. That's not the case, right? So you still have to hustle into the deals. And I would say that the most successful ones are the ones that live and breathe venture and really just love their job. And wherever kind of you go, you meet them because they're all at these events and find the best entrepreneurs. And that's what I would say is what unites the best ones.
Yeah, I'm baffled every time as an LP, because we're angel investors LPs, right? When we one of them meets someone that doesn't know UVC, and I'm like, you know that I angel LP invest, but you haven't really listened to the podcast or followed the newsletter. First of all, fuck you. No, no, but it's kind of like, as you said, if you're not in the ecosystem everywhere, you're not going to make it. You're just not going to make it.
Exactly. Yeah.
Do you think it's viable, because you're pan-European and you're also, so you do SaaS and consumer, but it is somewhat wide in the sense that it's not only infra or something like that.
Yeah.
How do you think about the specialization of venture? Do you see that coming more and more when you look at an emerging manager you look at today? When are you comfortable that they're generalists? When are you not comfortable?
So look, we are a generalist fund, and we had a very clear decision to do that back in the day, because we feel trends come and go, right? So if I think about kind of 2012 when we started angel investing, back then would have been a good time to say, hey, we focus on e-commerce companies, because back in the day it was the heydays of e-commerce. Now it would be absolutely terrible, right? To be a fund focused just on that. So therefore, I think being a generalist fund, so you are agnostic to whatever theme is out there, as long as it has a tech component. And then I think there are always waves with these specialized funds. So suddenly you had a bunch of crypto funds, you have now kind of AI focused funds, you have many climate focused funds. I think it can work if you are then extremely good in that specific sector and very focused on that, and then build your brand there. I think then it works. I'd say for the majority of those funds, though, it doesn't necessarily work. And I think how we as a generalist fund see it, we have kind of split the firm across different verticals. So there's always one partner and one or two junior members of the team kind of focusing on that specific vertical and driving our thought leadership in that, right? So if you take fintech, for example, then we say, okay, look, what are the key themes we look at? What is it that we like? What is it that we don't like in companies and business models out there? And then kind of we brief the whole firm on that, so everyone comes with a prepared mind while they meet other entrepreneurs. And therefore, you build the same kind of competence and know-how internally, but just structured in different kind of sub-teams to drive that.
Yeah, and I think that makes a ton of sense. I do think that as a new firm today, you got to be good if you want to be pan-European and generalist. That's my only comment to it. But I do think that obviously we have great firms that are generalist and pan-European today. I think that the time where you can start that firm may have passed, at least for many. But that's just my reflection. I'd love to ask you, because we did a deep dive retreat, or deep inner work retreat a couple of months back, and this is of course around coaching and finding yourself and staying true to yourself, and I am very much leaning into that work because I think it's incredibly important. Anything that you can do to optimize the performance either of a VC or a founder will, just come back so many times. So for that reason, and we're all dealing with stuff. Most of us are also trying to create a family at the same time as we're in a high performance job. That definitely comes with its baggage. That's not easy, and you need to manage that. And you've then launched at Cherry Ventures your co-pilot program, and I'd love to ask you to outline that, and then talk about the origins of the reason to do so, and what you've gotten out of it so far.
Yeah, happy to. So yeah, kind of we launched co-pilot, I think almost kind of a year ago, because we said, hey, the best athletes in the world have a coach, multiple coaches even. Why do not the best entrepreneurs have a coach? And I think we as partners ourselves have been users of the product coaching, right? So navigating kind of your life, your professional and your private life with a coach on your side, I think makes a huge difference. And I think there are moments or even phases in your life where you need it a bit less, and other moments or phases where you feel like, hey, I now really need someone as a sparring partner on the side that also helps me grow or kind of manage a difficult phase in life. And therefore we said, hey, let's also implement this for founders. And I think if you look in the sports world, so a good friend of mine, he's a world-class triathlete. I mean, he just kind of retired from his career. He won Ironman on Hawaii 3 times in his life. So amazing career. And when I talked to him kind of about coaching, he's like, yeah, of course I have coaches like my whole life, and not just one. Like I have a nutrition coach, I have one for my like bike riding, one for swimming. So it's, a bunch of different coaches that then even have to work together, which is luckily one thing we don't have to orchestrate. So I think one coach per person generally is enough in business. Yeah, I mean, for him, it was completely natural to have that coach, and he's like, otherwise, no way, kind of he could have gotten to where he got to. And then we said, hey, let's launch this as a program. And then we thought about what's the best way of implementing this, because if you just give this as an advice and say, hey, we think our founders should take a coach, then everyone says yes in the beginning, but then it somehow kind of fizzles out. So what we did is we implemented this into our term sheet. So as one of the clauses, it says, hey, kind of you participate in the Cherry coaching program, which means you set aside a budget of $50K per year for the founding team. And, that can come from the investment amount that we invest. And then we have a pool of around 30 coaches that we recommend, but it doesn't mean it has to be one of those coaches, right? If a founder says, hey, I found this coach, or I'm already working with that one, obviously totally fine, right? So we've kind of no preferences kind of on that. But, obviously these 30 coaches are curated. Either we have worked with them or heard very good things about them. And we feel like by committing to at least this 12 months, kind of it helps that it's also a continuous effort to build the founders out kind of as good leaders, because suddenly they are growing their business from originally maybe like a 5 to 10 people team to a 20, 30, 40, 50 people team in a year. And that comes with lots of new challenges, being a good leader, being a good role model, being visionary on the one hand, while also still being deep in the business. And we feel this can be best done with a coach on your side. So that's kind of why we implemented it. I think it's a big passion project for all of us as partners. So, we're really passionate about it, and also make sure that this gets implemented after we've signed the term sheet.
What's been the reception?
Extremely good. I think we have never kind of received pushback or anything from founders. I think for some of them, it was a bit new, and it was like, hey, like why? Like, is it only for us that you have this clause because you felt during the pitch we didn't come across as senior enough leaders? But then obviously, for example, no, it's for everyone. It has nothing to do with you kind of personally. I think they all like it, and once they start working with it, if they haven't worked with a coach before, so mostly for the younger founders, they really love it and embrace it, and I think that's great to see.
It's also, I'm sure, what you've perceived with the founders and the VCs that you know in the ecosystem, that this is consistently work that the best performers do.
Yeah, I would say, I mean, also, looking at kind of many different founders, I think if you want to figure out like what are the common traits that the most successful ones have, is I think they all surround themselves with very good and strong people. And I think, one element of that is a coach. Another one is you surround yourself with other very successful entrepreneurs that are maybe 2 to 5 years ahead in their journey, but you can learn from them. Like, how do I best set up my sales team? How do I best raise the next financing round? Like, how do I take care of my team? So a bunch of different problems and challenges that come on the journey, and people that get kind of the right advice from top people, that is kind of what makes you successful.
I'd love to ask you about culture inside Cherry. What have you kind of learned so far that's absolutely pivotal to make a high performance culture when it comes to decision making? Because that's really the product of a VC.
Look, I think what we believe is that you get to the best decisions via complementary views. So that's why kind of in our partnership of 6 partners, we wanted to make sure we combine as many different views as possible, and not just having whatever 6 German white males. I don't think that gets you a very balanced view on things, right? So and I think kind of the more diverse views you get, the better it is. And what has helped us is, for example, when we do an IC meeting and the team kind of leaves the room, we do a voting, and no one is allowed to talk until the last person has voted, right? Because we want to make sure you are kind of in your own mind, you don't get a comment that could suddenly influence you. And therefore, we want to make sure you stay kind of as neutral and true to your own view as possible. And then after everyone has voted, obviously, you have a discussion around it and bring together all these different views. But yeah, I think that has worked well for us in making sure there's no groupthink and there's no everyone tries to take the same view. And it's always this certain type of founder that is great. I mean, if it was so easy that it's only about a very narrow type of pattern recognition and always exactly the same founder that went to HBS and was 2 years at Goldman and then 1 year at McKinsey, yeah, then this job would be fairly simple. But you want to find the outliers that have done different stuff, that have a career sometimes that is not 100% straight. But yeah, it doesn't come with a clear pattern. So that's what makes the job a bit harder, but also way more exciting.
Yeah. What have you struggled the most with when it comes to building culture inside Cherry?
I would say since, kind of compared to Zalando, we are a small firm, right? So overall, we are 30 people. So I think in that size of a team, you can still have a very kind of clear DNA, a very good culture. We built our values early on, to make sure kind of everyone that joins us in the onboarding gets worked through the values, understands them, and in kind of in our weekly meetings, I think you quickly get the sense of, okay, how does Cherry work and how does the Cherry culture work? And in interviewing people that we want to kind of bring on board, we spend a lot of time on this cultural fit, right? So making sure they are a fit, they resonate well with others, they're likable, they're not ego-driven. So I think having a strong focus on picking the right people that fit to our culture, that does already a lot of that work.
Tell me a bit about your marketing background and how that has influenced your work in building Cherry.
Look, I'd say with the former CMO hat on, obviously, when you start a venture firm, and also again, it's 10 years back, right? So you look at the market and you feel like, everyone has a blue or black logo, just a few letters, nothing, super like standing out. And then we thought, hey, why are we actually not doing this differently? And it started basically with a name, right? So that we said, hey, let's come up with a name that is not super standard. And since I grew up on a strawberry farm, it kind of and I was the marketing guy, so it was obviously my job to figure out the name. And I always liked the fruit part of it. And then apple was taken, banana ventures wouldn't work, so we quickly got to cherry. Really liked it and played around with it, designed a logo that was different from most other firms. And we believe, look, as a venture fund, in terms of marketing, it's not that much that you have, right? It's your logo, it's your website, it's your people, and your office. That's pretty much it. And very few people see actually your office, right? The founders you interact with, but by far not everyone. And then it comes to website and logo that is kind of more out there. So you want to make sure that this really works, and that you also continuously work on it and get it to the next level. It's obviously kind of a passion of mine, and also kind of Philip. I think he loves it as well. And I think kind of it does make a difference in a crowded market to have a good brand that stands out and that sets you apart.
Yeah, and you've done an incredible job. I think
Thanks.
if anyone has ever encountered the Cherry brand, you don't forget it. It's very different from the rest of the venture ecosystem. So I think I can only imagine, I wasn't a venture 10 years ago, but I can only imagine 10 years ago how much it stood out. Notion pages as websites, you've seen that now from multiple funds, more edgy styles. You've seen that more now. But 10 years ago, I'm sure that it felt very surprising to many.
Yeah, we even had a long debate about the color. So because if you talk to kind of marketing branding people, they tell you, look, blue is actually the best color for a venture firm because that's what all insurances use, because it gives you trust, it's calm. And so I'm like, yeah, but it just doesn't stand out at all. And therefore we went for pink, which is the opposite, which is a bit more free radical and just very different. But yeah, we felt we can bring across the trust in a different way. We don't need a blue color for that, but rather one that sticks out.
I have a curveball for you, a marketing curveball.
Tell me.
You're coming to talk at our EUVC summit, but this morning I woke up thinking, maybe I should call it the Mega Summit, meaning Make Europe Great Again summit. Is that too bold? Is that a good? This resonator of the summit is to reset the narrative on Europe and try and big up Europe a bit more than what has been done so far.
I think, look, it's needed now more than ever, is my feeling, right? So I think if you look at it's kind of European tech, right? I think we've been through kind of a great, let's call it, first wave of the last 20 years. But there's still a lot to do to catch up kind of on the US market. That's way more mature, that has way more funding, many more kind of big, large tech companies, but also large private tech companies. So from that perspective, I think it's still almost day one for European tech. And I think we can't be bold enough to promote this and attract people. So I think whatever is needed for that, that kind of that sticks and that people remember, go for it.
Okay. Sounds like it's been approved by the marketing team. I like it, Mega Summit, and then we'll do caps and everything. Big giant flags. Yeah. Fuck, this is gonna be good. But we're rolling with it. Thank you, Christian. Let me ask you another question. You've gotten Sophia Benz on the team as well, one of Europe's absolute leading female investors, bringing a absolute excellent team together in venture. I've always kind of said that it's very hard to scale the uniqueness of the founding partners of a venture firm, and thus it's very difficult to scale in venture without diluting results. One thing is that the dynamic around investments is that it's obviously harder to return 380 or 320 in your case than it is to return 30 as your first fund. But there's also this scaling of human capital and being able to find both partner level people and general partner level people, but also even principals and associates that can really play to the level of a founding partner team. And because venture is so concentrated on few people, it gets very easily diluted. If you have a founding team of a startup, you end up with 1,000 people very quickly, or 100 or 50. So it kind of, you still have this apex in the top there that's leading a lot. But in venture, everyone touches the ball a lot. So I'd love to ask you, how do you think about that?
Yeah, good point. Look, I think, the bar always needs to be super high, right? For any team member, I think, in venture, because you are a small firm, right? And everyone is visible, everyone interacts kind of with our founders or potential kind of founders that we want to back. And therefore everyone needs to be super good. That is different from, you're building a large company and then maybe you've hired someone, you figure out, maybe that person is not the best one for the marketing department, but hey, this is an amazing sales guy. So why don't we, shift that person over to the sales department, and then the person has an amazing career there, right? So in venture, that doesn't exist, right? There's just one department, which is the investment team, right? And then we also have the strategic resources team, but it's a bit different. So from that perspective, you got to be sure that the people you bring on board have high standards, kind of have the same DNA, can quickly get the culture of the firm. With Sophia, we got to know her over actually a period of 4 years, while she was kind of a very active angel. And then we had done a bunch of deals together. So where she kind of was invested beforehand, then we led the next round, or we came in together into that round. So we got to know her actually quite a bit over that period of time. And I think that was important to build up that relationship. And then one day when all stars aligned, we wanted to bring her on board, and she was also really keen on joining us and going more towards the early stage again. It was perfect, and we're super happy to have her. Obviously, she's a big figure in the Nordics, and she's done a bunch of great investments there as an angel before, like kind of Aura, Sana Labs, and a few others, and then also with Cherry. She's done a bunch of amazing deals for us there. Goals, kind of an amazing and exciting gaming companies that's taken on FIFA soccer, and then Juni as a big fintech in Stockholm, and a bunch of other companies. So super excited to have her. And I think what we could quickly see is that this entrepreneurial DNA that she brought from Spotify goes very well kind of along our DNA, and that is obviously important.
Absolutely. Now I want to shift to a very different topic. I want to ask you about navigating this past period in venture, because you hold 50% back for follow-on rounds, and we've just been through this downturn, and that of course means that you've very much been sitting on a pile of cash figuring out what do we want to do with this. So maybe you tell us a bit about how that this period influenced the deployment decisions that you made, but also, how you were thinking about some of the deals you chose to do in the period.
It's correct, as you said, right? So we invest 50% of the fund in initial investments, and then 50% we reserve for follow-ons. I think what has changed there, so going 4 years back, or even 3 years back in history, when it was a period of zero interest rates, and everyone going crazy. It's all about growth, regardless if the business model makes too much sense. I think everyone has deployed capital a bit too fast, and especially in the follow-ons that raised, on fairly high valuations already. I mean, we've had in the portfolio Series A's on a 400 million valuation, right? And that was like 6 months after we had done their seed. So, that it felt already a little bit what's happening here, and that has calmed down quite a bit, right? So I mean, might still happen on super hot AI companies, but generally that has cooled off quite a bit. And then if you look at the statistics from Carta and PitchBook, you see kind of valuations of Series Bs and Cs have gone down massively, actually, compared to 2021. So the way kind of we look at this is the reserve money that we kind of save is for companies that have shown that they have very clear product market fit, which is not always the case at seed stage, which is completely fine. But at A, kind of you should kind of be able to prove that. So product market fit. And then obviously, how has the team kind of developed? Have they been able to bring on great talent? Were they able to secure amazing customers that love the product, that have a high NPS? So kind of, we keep that money on the side for companies where you see, hey, everything is working out nicely. It's not too capital intensive as a business. And then, we keep funding them over the next rounds. And I think it's getting a little bit back to how our venture was like maybe 6-8 years ago, and in a bit more of a moderate pace that has been kind of a bit out of order in 21 and 22.
Being a SaaS investor, you're the natural guy to ask about this, because I don't know, but could you tell me a bit about how the metrics in SaaS have kind of changed over time, and where we are today? Are we as focused on profitability as we were right after the crash, or are we a bit back to saying now it's actually we're not as profit focused now?
Look, I'd say if you start kind of I think the easiest KPI to always look at is what's the multiple to get to the valuation, right? And if you look at the revenue multiples in the crazy times, they went up to 100 times net revenue, right? And I think that was crazy. And then if you look at now how the market came down, especially public companies that are obviously the easiest thing to look at because they give you a price every single day, right? And they trade somewhere, depending on the company and growth rate, but between, I'd say, 6 to 10x ARR, right? And therefore you can say, look, in private markets where companies are growing faster, so they're growing at least 2 to 3x, there is a reason to say, hey, this multiple should be higher than 10x. So it can be 20, 30x. I think that's what we're seeing. What we saw when the market crashed, multiples also went down quickly. No one knew really like what's happening. So people were also kind of investing at a much kind of slower pace. But by now, I would say, if there is a high quality company, I think multiples also go up quickly, not back to the 100 times ARR, but to 30, 40, 50 times. That can still happen, right? If people feel like, wow, this could be a breakout company, I'm willing to pay X year's price. So I think that is what you see. Sometimes that people are like, hey, it's an amazing company, so I'm happy to pay next year's price today because I believe they will easily get there.
How do you reflect on the period that we were in? How do you talk about it to your own LPs about, you have to play is your view that you have to play the game that's on the field, and that was the game that was on the field, and that was just, we had to do it? Or are you more saying, no, we should have actually shown bigger discipline? How do you think about this? Where do you think we are as an ecosystem?
Yeah.
What's the truthful thing to say here?
Look, I'd probably take a nuanced view, right? So I think, and obviously when we reflected on the past, right? I mean, now in hindsight, it's always easy to say, oh, like how how could you invest in a quick commerce company and this and that, right? So I think, but looking at it now, I think the teams kind of we backed, I still feel they were great teams. And I think we probably do it again. I think what went kind of out of order was also the whole market, right? So there was just way too much money flowing into the same business model, going against each other. And that drove up valuations, but that also kind of ruined the P&Ls of these companies because they were all burning through, like in some parts, like hundreds of millions a year, right? Just to gain market share and just to be the number one. And I think that was not very wise, right, of the whole industry. And I think that has changed now. So I think people understood that. They got the memo. So I would be confident that we are in a much better place now. And, with a few exceptions, I think there are some AI companies that might be overhyped. On the other hand, there is also a chance that they become really big outcomes. So that is then also the magic of venture. It's still risky, but it also has high upside.
How do you think about it on the because right now, as you said, it is the AI companies. How do you think about it when probably it's not as much, maybe it is, but at your first investment, but the follow-on investment is oftentimes where you can see some substantial valuation gains that you are happy about that is in your portfolio, but you're very wary of underwriting the new round.
Yeah, exactly. I think that is what has changed for most funds, is that the initial investment, if it's kind of on okay terms, I think it's always fine to do that because you take the chances, and that's kind of our daily business. I think where then usually kind of mistakes happen is you just keep piling money into the company, which, if it works out, it's amazing. Yeah, you've done everything right. But if it's still risky, and it's basically still as risky at Series A and B as it was at seed, then I would be a bit careful about it. I think it's fine if you do this out of a $10 billion fund, right? Then, if you invest 50, 100 million at Series B, fine if it doesn't work out. But if you do this as an early stage fund with a very different fund size, kind of you have suddenly a big concentration in your fund that you actually don't want to have because it just kind of blows up one position that is still not really de-risked.
Yeah, absolutely. And that's exactly the two problems, right, that we experienced. We saw exactly those two things play out at an extreme scale. You saw no de-risking from round to round. And then you saw a lot of smaller funds playing a game that's only privy to the very large funds, because otherwise it just destroys the fund model for anyone participating in that if you're small. I'd love to ask you, going into 2025, what makes you most excited? What are you most excited, aside for the Mega Summit? What are you most excited about?
That's obviously a big one. I would say, look, what are we excited about? I would say, on the one hand, I think there are kind of a bunch of exciting investment themes out there, right? So, I mean, AI has been the biggest trend kind of this year. I think it will also continue to be the biggest trend next year. And I think we will hopefully see many exciting new companies being started in the application sector of AI, right? So kind of interesting, we've seen a bunch of interesting agents already popping up, but there will be much more, right? And I think there will be really kind of big companies being built in this field, and extremely excited kind of to meet many of those founders in the new year. Then there's also obviously robotics kind of is a field that we like. I think it's a little a harder nut to crack because it's not only getting the software part right, but it also means you need to get the hardware part right, which is just adding like another big layer of complexity and of risk. But I think there are kind of still many, if you look at manufacturing, warehousing, logistics, I think there's just so much that can get disrupted by robotics. So there's, still a huge playing field out there. And then I would say kind of overall, looking at next year, I think looking at Europe, and I think now kind of with Trump being elected, which might mean that I think we as Europe also kind of need to focus a bit more on ourselves and how can we become a powerhouse. Because one thing is clear that, Trump is going to do a lot to make sure that the US is doing well. I think generally also tech will do well under him. I think that's pretty clear by now. But I think we in Europe need to see, hey, let's get our stuff together and make sure we build amazing companies here and do everything foster our own ecosystem. And I think there's still a lot to do.
Couldn't agree more. Sounds like we have the Mega Summit warm-up speech ready to go. Thank you so much,
Absolutely.
Christian, for joining.
Yeah, you're welcome. It was fun. Thanks a lot for having me.
This was their finest hour.
Tear down this wall.
It's more than just an alliance. This is a union of values.
Let's start acting.